Hello, everyone, and welcome to the Palumbo Podcast. My name is Philip Palumbo. I'm Chief Investment Officer, CEO, and founder of Palumbo Wealth Management. The Palumbo Podcast is a podcast where we interview some of the most successful founders of businesses to learn how they got to the top. We also interview some of the most successful market strategists, economists, and portfolio managers. Today, we have with us Andrew Clinton of Clinton Asset Management, who is a big partner of the firm, a friend of the firm, who's done a really great job for our clients. And Andrew, first, I want to say thank you for taking the time to speak to us today, to give us your perspectives in this challenging market environment. So appreciate that very much.
My pleasure. Thanks for having us. And we appreciate the partnership as well.
Of course. Yeah, absolutely. And I love the vest,
That's what we're here for, right? Product placement.
Exactly. All right. So Andrew, what I'd like to start off with, as always, and I love your perspectives about the economy and interest rates, et cetera, but let's start first with the economy. And so when you think about everything that's happened coming into this year, it's always been my view that I look at it like a balance beam where you have tariffs is the part that's going to weigh things down. But the other side of that, right, is going to be the deregulation, incentives, and extension of tax cuts. And also AI and technology revolution we're seeing, plus reshoring and investments that'll occur as a result of that, are reasons why, for me, looking out more 12 months, 18 months, I'm very optimistic. So I'm wondering where you are today with the economy.
Yeah. So to say that it's been I would say, volatile period for all markets is an understatement. I think everybody can appreciate that, given what we've just come through. There's a high level of uncertainty, and everybody's sick of that word already. I'm sure you are, as we are. The reality is the uncertainty is likely to persist for some time. We also know with a high degree of confidence what uncertainty does and the impact it has on economic growth. It's been modeled by Keynes, specifically in terms of economic models. We know that it takes about 1 to 2 percentage points off GDP. So if you've been following the economy as we have very closely as fixed income investors, it's a fundamental and essential piece of the foundation of investing in fixed income, that and in inflation in particular. We know that Q3 GDP growth was higher than Q4, which is higher than this year's Q1, and then this quarter actually looks like it's potentially slower than Q1. Now, on an adjusted basis, it's important to mention because we know that the negative GDP from Q1 was largely due to a pull forward in demand as folks were importing goods and inventory and raw materials prior to getting hit with the tariffs in particular. But even if you adjust for that, Q1 was a slower growth rate than Q4 of last year, and this quarter is likely to be slower because now you've pulled forward all that demand into the first quarter, which is likely not to be there in Q2, 3, and 4. So our view is that you're likely to continue to see slowing economic growth in the next few quarters. There's going to be an impact, obviously, not just on growth, but also on potentially jobs. We're starting to see increasing notifications and announcements around job cuts. UPS just announced 20,000 job cuts. Right, those are significant numbers. Microsoft mentioning a few thousand job cuts, Amazon mentioning thousands of job cuts, and we have Doge specifically that has obviously been cutting significant, government jobs specifically, which are not showing up in the numbers yet, and likely will not show up given the actual extended employment benefits that many of the government employees were offered. You're probably not likely to see that until late second quarter, maybe even third quarter. So our expectation is that things probably continue to moderate, certainly from a growth perspective, and we're likely to see increasing job losses. And so in that scenario, it's likely to provoke the Fed, although they've been on the sidelines and stating that they're concerned about the potential impact to inflation. It's important to mention that this inflation, if there is some, and we haven't seen evidence of that given the CPI numbers that were even weaker than expected this week, some would argue that there may not be any, because inflation from tariffs is defined by how much of the inflation is passed through. And so far it's zero. Right. So that's not to say that won't happen, because a lot depends on what deals are brought forward and how much further reductions in tariffs might impact the broader economy and ultimately or not have an impact. But our expectation is that that uncertainty, both around economic outcomes, does three things. Number one, it really freezes in place any capital expenditures. If you're a CFO, a CEO, how do you make significant investments in equipment and manufacturing, either onshore or offshore, without some degree of certainty in terms of what your liabilities might be, either from tariffs or taxes, from that matter? So what we've seen is a significant slowing in capital expenditures. And it also has an impact on investors, your clients, our clients, because uncertainty ultimately, if we don't know with a high degree of confidence what's likely to come around the corner, there's a tendency for us to increase our savings rates, and there's a tendency for us to reduce our risk allocations. You saw a little bit of that, a lot of it, quite frankly, in April. You've seen a dramatic recovery when we've delayed the impact of tariffs. But the reality is, in large part, that the die has been cast. The economy is now slowing, and we're going to need some sort of catalyst to cause it to rise again. And that catalyst will likely be Fed cuts, right? It's going to be interest rate cuts. But this Fed is not proactive, right? They're just the opposite. They're saying we're going to wait till the actual hard data tell us that we need to or have to act. Chair Powell actually understands, I think, well, that his role at the Fed is temporary and is likely going to be finished by about a year from now. He's got effectively 8 meetings, now 7 meetings left in terms of what his role in the Federal Reserve is going to be. So what's his legacy going to be? His legacy, I'm sure he wants to be the other Fed chairman who killed inflation, right? We're at 2.3% CPI, pretty darn close to 2% inflation.
Come on, give me a break.
Right. So you're there, but the Fed is still saying, well, we're not sure. We need to get sufficiently back. We don't know. But this, as I said, this inflation is different. This is not a demand-driven inflation. This is a potentially one-time price increase. It's not like tariffs are going to go up again. Right. So we're likely a year from now to be looking at potentially deflationary environment.
Right.
And so that, generally speaking, is good for fixed income. It's good for fixed cash flows. And ultimately, in environment uncertainty, we're likely to see that slower growth transition to a discussion about where the opportunity sets are greatest, which we can probably get into.
Yeah. Okay. Love where you're going with this, right? So as an investor, what's on my mind as I listen to you is everybody believes that the economy is going to slow, right? And somewhat slow over the next couple of quarters. The big question that's on a lot of people's minds is it going to slow enough to cause a recession?
And it's a fair question. And I'll be very candid with you. We don't know the answer. What we do know is it could. And ultimately, we also know that even if it doesn't end up in recession, it could certainly feel like one, right? For those folks, when we're thinking about it, right, if we're at a 2% growth rate right now, just conservatively from a GDP perspective, and we know that uncertainty as it persists takes 1 to 2 percentage points off GDP, well, we're at stall speed in that environment already.
And which is pretty much what people are anticipating, a 0.5% to 1% growth, next couple of quarters.
Which is going to feel pretty awful, right? Yeah. And it's going to cause businesses to make decisions because they're not growing. If you can't simply pass through price increases without it impacting actual earnings, which is this is really what inflation coming down means to corporations. It's the clearest illustration of pricing power that we can see. So if you can't simply raise prices to increase your corporate profitability, you can't just pass through the price increases through, well, then you have to start cutting expenditures.
Right.
And what's your highest expense item? Unfortunately, it's employees. Right. So this is what the Fed was talking about in September of last year when they cut rates by 50 basis points the first time. The market seemed not to listen to what they were saying. They were saying we're recalibrating, was their term, away from focusing on inflation towards supporting the jobs economy. And the reason why the market didn't listen is because the jobs number in September of last year was a strong and actually higher than expected jobs number. And everybody said, oh, the Fed made a mistake. They should not have been cutting rates. They see the jobs economy is very strong. And yet the following month in October, 150,000 jobs were revised down. So that number went from being above expectations to well below expectations. But by then, the market and the economy had already moved on to a new narrative that they were excited about. And that was that Trump was ahead in the polls, that there potentially was a Republican sweep. that could be more pro-business and therefore create more economic activity. And now we're starting to see that some of those hopes and aspirations of the market may have been misplaced.
Right.
So
yeah. So as we think about the narrative, and I'm so happy you said you don't know as it relates to recession, because it's so important for people to know is that to try to predict a recession and when it's going to happen is such a freaking waste of time. It's just a complete waste of time, right?
yes, it's very difficult.
It doesn't help anybody. It really doesn't. I mean, if anybody can predict that, I mean, then it'd make investing so much easier, but it's just difficult to do. But I think what people really need to pay attention to is three things: jobs, jobs, jobs. If we currently have jobs, which we do, measured by the job report number that we just got, and also measured by initial claims, it still continues to suggest the job market is okay. Mm-hmm. As long as people have jobs, they have the ability to spend. That's really the bottom line. Until we start to see that numbers on the initial claim specifically over a 2, 3, 4, let's say over a couple of month period, starting to see, if you're starting to see that start to hike up, because a lot of things you talked about now, UPS, and maybe we'll see some of these government jobs, in the next quarter or two, then that's when we should really start to be concerned. And then that basically means from an investor in the equity market is that there could be a peak to trough drawdown of about 30%, 35% on average, right? Mm-hmm. So, but as of right now, it's just tough to make that call. So I appreciate that. So, but I also appreciate you saying about inflation. I really don't believe there's going to be inflation. I really don't. Because I think, if anything, it's going to be a one-time increase in cost to the consumer, and it's going to be a shift in behavior of consumers for certain products, a negotiation between the exporter, the importer, currency situation that could happen too, whether devaluing, that could also help things out. So there are so many moving parts to that. I'm not buying into the whole inflation thing, in my personal opinion. But I want to talk about the Fed, because this is really important. And we know this, Andrew. You and I have been doing this for a long time. Feds always make mistakes, always, and this Fed including. So I just don't understand.
Yeah.
If he knows that growth is going to be slowing, and he knows that inflation is at 2.3, why be reactive and wait for a certain data point to make a decision? Like, why would you do that? Why not just start to drop now to try to equal out some of these effects of tariffs?
It's a fair question. And if I can give you my cynical opinion, it's because of the reason I mentioned earlier, where Powell knows he's out of a job in a year. And he has a legacy that he wants to be able to carry forward. He'll write books and he'll be on speaking tours, and he'll get paid a lot of money for being able to say that he was the other chairman, the only living chairman of the Fed that killed inflation, and the difficult decisions that he made to do it. And if it ends up causing slower economic growth over the next 10 or so months as a result, so be it.
Yeah.
And that is and also, I hate to say it, but there's, the politics between the current administration scolding of the Fed to do something and the Fed's resistance to want to show that they're independent. There's definitely conflict there. So whether it's a personal issue or not, we have no idea. But the reality is that it has an impact, and ultimately the decision making is such that, and this is true of every other Fed as well, by the way, they're always late, right? They're always late in the raising of interest rates and the tightening of financial conditions, and they're late now, right?
Yeah,
in our view, they should be cutting right now, and they're not.
Which is my view too.
And so the impact of that not easing financial conditions right now means that financial conditions continue to tighten every day. And so ultimately, when they do see the hard data catch up with the soft data, since they clearly are not being proactive at the moment, they're going to ultimately be forced to cut interest rates more than they would have had to under normal circumstances if they had been more proactive. So that's the challenge that the Fed faces. It is really a rock and a hard place, and you're dealing with people and personalities who are humans like everyone else, who have their own biases that ultimately drive their decision making. And it's a committee, right? At the end of the day, folks have to coalesce and consensus build, and the right decisions are not always arrived at. And that's the reality.
So I'm going to take the flip side of this a little bit too. So back in August of last year, when I was looking at everything, I argued for the idea that I said that I would not be surprised if the Fed hikes rates before the Fed cuts rates, right? Mm-hmm. The The reason why I said that, because he was telling us that as long as inflation is a problem, right, which it was at the time, he's not going to cut rates. And in my view is, why don't you hike rates to really stamp out inflation? And we have a huge housing problem where there's lack of supply because everybody's locked into these low interest rates. We have a whole group of a generation that is looking to buy homes that can't because it's unaffordable. And so, and I hate to say this, but knocking us into some sort of a recession by hiking rates was something I think we needed to clean up some of the issues that we have in our economy. Mm-hmm. Do you buy into that?
Well, I think it's a fair statement in the sense that in the context of what recessions are, they're just a natural part of the business cycle.
Right.
When you see expansions and you see contractions, the reason why, because ultimately what we as human beings have a tendency to do is become too optimistic when things are too good, and we become too pessimistic when things are not going well, right? And so ultimately it's a natural part of the process to have the market normalize. We've definitely, as you've seen over the course of the last few months, we had gotten to extremes in terms of the valuation of risk assets and starting to think about it, right? And as we're thinking about it now, we're still talking about it with clients today, which may be a good sort of maybe digression for a moment, is that as you're thinking about the returns of the available asset classes that you can invest in today, and we're representing the municipal fixed income asset class, we're delivering yields to clients today of around 4.5% to 5%, tax-free. Taxable equivalent, you're looking at 8 or 9%, depending on what state you're in. There's virtually no other asset class that you can invest in right now with the same credit quality, call it single A to double A credit quality, and get the same kind of return if you're somebody in the highest tax bracket. If you want to get an 8% return in taxable fixed income, you have to go into single B jump corporates, right? Those have a default rate of 20% over a 10-year holding period. Right. 1 in 5 bonds that you own in the single B space are likely to default over that time frame. Munis have a default rate of almost 0. Right? We've never had a default in the history of our firm or my entire career over 30 years. So munis are much safer. You can go to maybe preferreds, but again, preferreds are much more sensitive to equity prices than they are to fixed income. And so therefore, they're much more volatile. You can go to private credit, but private credit has its own issues right now, which we're talking about in terms of payment in kind and seeing them actually, the underlying holdings go from debt to equity, which is not a good thing, by the way. But they're also charging much higher fees and they're lockups, right? So clients can't get liquidity if they need it. Again, very different asset class. And the other option is equities. So, and this is what we've been talking about with clients, in terms of, it's all about the starting point, both with yields for fixed income and valuations for equities. Valuations on equities right now are in the top third of the highest valuations ever in history. That's not to say that they necessarily have to come down. We're just trying to give clients a sense for what their expected return should be based on where current valuations are today.
Right.
We're putting new money in today. And current valuations based on history have stated that when you've been at these valuations or higher, your average return over the next year has been 1.8% for the S&P 500 over history. If you look over the next 10 years, it's been 2% annualized over that 10-year period. And then you've got David Costin at Goldman who's saying, nope, it's going to be 3%. Or you've got Vanguard in their playbook saying, nope, S&P is going to be 4%. The reality is none of them are saying 8%. And even if you're able to get 7 or 8%, which has been the historical average for the S&P, we're already there in municipal fixed income just from cash flow alone. And you don't have to take equity risk to get it. Right? You just get high quality fixed income offering you equity-like returns. So it's a pretty unique moment in the market, which is why we're saying for folks who don't have a lot of exposure to munis or are considering adding to their exposure, it's a really good time. There's only been a handful of times in history where you could get close to 5% tax-free yield, and this happens to be one of them.
And I think that's a really good argument, right? So and I've read these studies time and time again, even the CAPE ratio where it's trading at and future returns, exactly what you just said. So basically what all these statistics are saying is because the market is trading so rich, if you invest today, the future expected returns is somewhere between 3 and 4% over a 10-year period. And if we invest with you in Muniland and get 4.5%, taxable equivalent of 8.5, you're taking much less risk than the equity markets. My personal view is that that's where stock selection is going to be extremely important over the next 10 years. Sector selection as far as trying to make decent rates of return.
Yeah, and just to be clear, that's not to suggest that all equities. It's just the generic.
Yeah,
You got an ETF or an index, the S&P 500. That's your baseline.
I agree with you. I want to, because this obviously relates to what you do. So I want to talk about deficits. Well, actually, before I get into that, expansions and contractions with the economies. Do you feel like they've shortened?
So,
and if so, why do you believe that is?
Yeah, it's pretty unique in the sense that we've come through this historic period of expansion, right, which we had prior to COVID. What people don't realize is that during Trump's first term, we're already heading towards contraction prior to COVID. The Fed had already begun easing. Right. Prior to March of 2020. And if it were not for COVID, we would likely have ended up in recession eventually. So the fact of the matter, and so going back in time, the traditional business cycle has been anywhere between 5 to 10 years on average.
Right.
You could argue that over the course of the last 20 years that those expansion and contractions have extended out by virtue of the use of both fiscal stimulus as well as monetary policy. And that's primarily the reason why, again, most people probably don't think about that period during COVID as a recession, but it really was. It just lasted a month. Right. That's really how long it was, because of all the both monetary policy and fiscal stimulus that was poured on the economy, such that it made it a very dramatic snapback and V-shaped recovery over literally 30 days almost. Yeah. And there wasn't time for, and thankfully, most folks who were actually gainfully employed stayed employed because of the PPP programs that basically kept everybody in their jobs, even though, let's say, they couldn't have worked or would have normally been laid off otherwise. So there was a lot of important and I think necessary steps that were taken. And so now what we're dealing with is, okay, we came out of COVID, and then we actually went through a dramatic further expansion in fiscal stimulus through the IRA, specifically the Inflation Reduction Act, the American Rescue Plan as well, which gave state and local governments $500 billion in effectively taxpayer money to recover from the fact that during 2020, they were taking in records amounts of tax revenue because nobody got fired. Normally, if people get fired, that means lower payroll taxes, that means lower revenues for municipalities. But that didn't happen in 2020. Nobody got fired, or very few did, thankfully. And so therefore, state and local governments took in more tax revenue in 20 during COVID than they did in 2019, before COVID. And then they took in 25%, almost 30% more tax revenue in 21 than they did in 2020 during COVID, and then got $500 billion from the federal government. So state and local government, finances have literally never been healthier in my entire career. But that money has now run out. Maybe to where you're going with your question, because now the question becomes, all right, so if we're starting to deal with issues, especially at the state level, of deficits, like in California. So California, as Newsom just came out and announced, is now staring down the barrel of a multi-billion-dollar budget deficit. And he's saying that it's because of the slowing in the economic growth, and it's going to require the state to start cutting services, to start cutting expenditures, whether it's through the healthcare plans that they were giving to the underprivileged in California. Either way, the important point of this is that using California is a great example. It just came out, this is a couple of weeks ago, this was released, that the state of California's GDP is now the third largest, not in the state, not in the country, but in the world. Yeah. Right? The state of California's GDP is now larger than all of Japan.
Amazing.
So it is amazing, right? To the credit of that state and all the innovation that's happening there. The problem is it works both ways, right? So as much as the expansion has caused that economy to become very large, when it starts to contract, it doesn't just impact California local economies, it impacts the entire country and the globe. Right? And it's not just happening in California, it's happening in New York, it's happening in Texas, it's happening in Florida. So as we start to see that there is no more public money saving these state entities, that 49 out of 50 states have balanced budget amendments, which require them to match their expenses with their revenues. If the revenues fall, they've got to cut. And so the cutting of expenditures means that the economies and the local economies slow, which is obviously what leaks out into the broader economy, which is going to put more pressure on GDP growth. So this is just how it works. It's just a natural progression.
Right. So going back to what I was talking about before with expansion and contraction. So what I think a lot of people sort of understand, but really don't understand, that the expansion that we've had and the growth in markets all around the world, a lot of that is because of fiscal spending and zero interest rate environment or very low interest rate environment. So the returns over the past 12 years, 15 years of the S&P 500 averaging 12 to 13%, it was really it's an aberration. It's not normal to be at those types of rates of return, and a lot of that's been propped up due to fiscal spending. Now, when you think about things going forward, Andrew, and you think about Doge, right, and you think about the current deficit and the goal of bringing that to 3% of GDP, which is something that Besant's clearly talking about. If we don't put the economic growth in the hands of the private sector and we leave it in the government sector, it's over, in my opinion. We have no choice but to move that into the private sector.
Agreed. And it's going to take time, which is why Besant came out and said, look, we could do that right now. We can get to 3.3 today. The problem is it would be very painful and would likely result in a significant contraction in growth and recession. And
right, don't you think so, Andrew, but don't you think, I mean, it's like in life, unfortunately, you do have to take, one step back, two steps back to take 3, 4, 5 steps forward. It's like, when is this country and other countries going to just lay the hammer down and do what we need to do to clean things up? Because the question is this: if I'm listening to this right now, I just want to know, well, if we don't lay the hammer down and make really hard decisions, what does that potentially mean for us a year, 2, 3 years down the road? That we're just going to go into a Great Depression, right? So, are we going to be able to just move along here successfully with all this debt over us and the deficits that we have?
Yeah, it's
fascinating. It's hard to know definitively.
It's a difficult question to answer. I don't have the answer. I only have an idea because we've seen a little bit of this movie before, in the sense that there have been prior periods because I think what you're alluding to, and I would agree with, is we're moving back toward a more normalized economy.
Right.
And within the normalized economy, you also have normalization of monetary policy. This notion of using QE to specifically prop up the asset prices, which will ultimately drive economic growth, is not something the Fed wants to use. And it's not something they have any intention, if they can avoid it, of using going forward. They simply want to raise interest rates, short-term rates, or lower short-term interest rates, which would be normal based on prior business cycles. The problem with that transition away from QE to more normalized monetary policy is those, and getting back to your original question, those instruments tend to be a bit more blunt, in the sense that when you raise interest rates, it takes longer for the financial conditions to tighten. And the reverse is true as well. When you reduce interest rates, it takes longer for financial conditions to ease. And so it ends up extending the period when you have either a slowing in the economy or you have a longer period of expansion in the economy. And that's okay. There's nothing wrong with that. But the problem is we've gotten used to this notion of V-shaped recoveries. So, when the Fed cuts rates, most people don't realize that it doesn't have an immediate impact, right? That impact doesn't happen for several quarters. So even if the Fed was to cut rates today, which they are not doing, things don't get better for approximately another year, if not longer. So one could argue through their forward guidance and a lot of the language that they use that they may have shortened that time frame in terms of the impact of actual monetary policy through the comments that they make and what they plan to do as opposed to what they actually do. But the reality is it's still several quarters. So that's the part, is that all of these, as we think about the changing dynamics of the U.S. economy, it's not a speedboat, right? We like to refer to it as an aircraft carrier. It takes a really long time to turn and reposition the U.S. economy. Right. And so using interest rates alone, as opposed to QE or QT for that matter, will take longer to have an impact.
So in terms of the deficit, and in terms of a lot of debt that's coming due, I think about a third this year, what is your view?
So one of the things that we've heard, and I think maybe within your question, correct me if I'm wrong here, is that this question about if we have an increasing deficit and therefore the need to borrow more and more in the form of treasuries, is it likely we'll see higher interest rates over time because either there's less borrowers, i.e. just say more supply and the same or lower demand, so therefore higher yields or lower prices. And what we're reminded of is really that within that question is a question about the primacy of the U.S. dollar. Because why does anybody own U.S. Treasury bonds? most sovereign entities, specifically public holders, that is governments of US Treasury bonds, own them because they kind of have to, right? When it comes down to the issue of the US dollar and its reserve currency status, I'm sure, and we know for a fact that it drives other countries crazy, that the US dollar is the reserve currency of choice for the entire globe. That likely is not going to change in our view for a very, very long time, right? 90% of all currency transactions in 2024 were denominated in the US dollar. What is the other alternative? It could be the EU, but the EU has its own problems in terms of the euro. I'm sure China would prefer that it's the yuan. The problem is nobody trusts China. Right. So the issue is it really comes back to trust. And so, and it's also important to note that think about how much debt that we've actually accumulated as a country over not the last 1 to 2 years, but over the last 30 to 40 years, right? The expansion of the US deficit has been dramatic and it's been going on for decades. And if you look at the direction of interest rates and their correlation to the expansion of that debt, what you find is empirically, there is no correlation between the outstanding supply of US Treasuries and the direction of interest rates. Everybody wants to say that there is, and it's a reasonable conclusion that at some point, maybe you issue so much debt that the world can't absorb it, right? That is the perception, but there's no data to support that. There's no empirical evidence that that's true at all. It's just a fear. And it's one that gets talked about, understandably, all day and twice on Sunday, because it gets back to that notion of, whether the modern monetary theory, this idea that the U.S., because of our ability to use the U.S. dollar, can simply run up deficits into perpetuity and in infinitum, right? The reality is that we can't do that. We know that, and we shouldn't do it. And it's not proper, or I would argue, a fiscally conservative approach. If we care about national security, right, and to whom we owe our allegiance to, right? We'd rather make those decisions what's right for our country rather than who owns our debt. So very fair questions, but the reality is that the folks, and when I say folks, the public holders of US Treasury bonds will ultimately own and buy more US Treasury bonds. So we're not concerned about that. We're not suggesting that the federal government should continue to spend wildly. And quite frankly, I'm not sure that, unfortunately, there's adults in the room right now from either party that seems to care about deficits. And the big risk, and I think this is the one we're all kind of concerned about and don't know the answer to, is, well, at what point does it matter? Right? Is it 125% of GDP? Is it 150% of GDP? Is it 200% of GDP? The reality is, what we know at the end of the day is there is a buyer of US Treasury bonds. The largest buyer of US Treasury bonds is not China. Right. It's not Japan. Right. It's the Fed. Right. If we need to monetize the debt, we will. That would ultimately have an inflationary impact. The reality is we don't have to do that today. We're not worried about that today. Good point. And that's the way we think about it in the because for fixed income investors and investors in general, right? Our biggest concern is what's our real rate of return? What's inflation and how much more return can we achieve above and beyond inflation? Absolutely. It's all about the real return. Right. So if inflation's at 2%, and in our space we can give you 8 or 9, that means you're getting 600 to 700 basis points of additional real return. That's a lot. It's for not taking a lot of risk. Yes. And so while the questions you ask, and I think are very fair, and we've been hearing them a lot as well, and I think they require very thoughtful consideration, what we have to think about is not necessarily what is the 6 or 7 standard deviation event, what is the least likely outcome. We have to think about what that normal distribution looks like in terms of what's the most likely outcome. Yep. And so one last point I'll make on this. Yeah. Because it's come up recently, as you've seen the US dollar depreciating relative to global currencies, the question has been posed, and I think the claim has been made, oh, that's a reflection of the world moving away from the US dollar. No, and so ridiculous. Right. Really but let's harken back to a period when there was real risk and concern about not just the US dollar, but capitalism in general. Right? It was a failed experiment at moments during the 08-09 financial crisis. People were saying, oh, capitalism is going away. The US dollar is no longer something we can count on. Well, I remember when the US dollar was trading at 80 cents on the euro, excuse me. Me too. Right. So we are miles and miles away from that
Right.
level of uncertainty.
Right.
So let me be the first or last to reassure folks who are concerned about the US dollar that the US economy and the US dollar is fine.
Yeah, I feel so strongly about that. And I say it because we are the best country in the world in terms of innovativeness, being creative. We have the greatest companies in the world, the greatest people in the world, the greatest entrepreneurs in the world. I mean, look at the companies like CoreWeave just became one IPO. Cerebras is going to file. I mean, these are phenomenal businesses. You know, when it comes to quantum computing, PsiQuantum is probably going to be the first company to come out with a quantum computer in 2 years or 3 years. So there's this country is just so amazing. I think people forget about that and they get too tied up in politics. And people forget that presidents come and go, and you know, they let that get the best of them. And that's, in my opinion, you lose the forest from the trees.
If I can give, that's a great point. If I can give you one data point that might be interesting. So this is actually a USA Today article that came out not long ago, because there's been a lot of talk about consumer sentiment specifically and expectations for inflation over the next year, that they've risen dramatically, right? And so I think the number is around 4% is what the quote unquote surveys have shown. But within the surveys, what's not discussed is the disparity of views, right?
Oh my gosh.
Right. So they take the median of the actual respondents, but they don't tell you where they are. So if you actually look at the difference in terms of views between Republicans and Democrats, so I'll let you guess, maybe you know the answer to this already. So what do Democrats believe that inflation will be a year out from now? Do you have
Very high.
6% is the expectation. What do Republicans believe inflation will be a year from now? 0.4%. Right. So, and I guarantee both will be wrong. Right. The reality is, though, that is such a wide range that you can drive a truck through it. And so to your point about, you know, these our own biases that we all have, political or otherwise, value systems that we use to make decisions, unfortunately end up clouding our ability to be objective and think about things from based on where's the data, what does the data actually say, as opposed to what's somebody telling me to think. And for both sides, it's a problem.
It's really incredible how polarized both sides are. I'm bothered by both sides. All right, on the Democratic side, I'm bothered by how emotional they are, that they believe that he's going to blow up this country. Inflation is going to go to 6 and 7%, just like you just said. And then the other side of that, the Republicans feel that Trump can't do any wrong, that everything he's going to do is going to be perfect. Don't worry about it. And there is stuff to worry about in what he's doing. So on both sides, it's just way. It's so polarizing, and they're way to the right, way to the left. And it's just, in my view, it's distorting a lot about how you have to think in a more pragmatic sense. So I want to turn this conversation to the most important part for all of us is interest rates. Mm-hmm. So just to give some perspective, I'm looking over to the screen here. If you see me doing that, that's because I'm just looking at my screen right now. So the 10-year, something I obsess over, is currently at 4.4, you know, touched 4.5, bounced off of there. And then the 30-year started moving to closer to 5% and touched it. And then over the past couple of days now has moved off of that level. What are your, and so right now the yield curve is no longer inverted, mm-hmm. right? So we're positively sloped. So what is your view with rates? Where are we going?
Yeah, so it's a difficult question because there's been so much volatility over the last, I would say, 6 months, right? I mean, one of the things, it's again, harken back to September of last year when the Fed cut rates by 50 basis points. Never in the history of the United States has the Fed cut for the first time by 50 basis points and then seen rates rise by 100 basis points over the next 3 months. It's never happened before. So to say that it's a unique moment is pretty extraordinary. We have competing narratives, which tend to drive consumer and investor sentiment now. It's remarkable to us. We follow the flows in terms of inflows into bonds and specifically positioning in 10-year treasuries in particular, because it gives us an indication of what the asset management industry is saying. So asset managers are out there extending duration, obviously expecting not only the interest rates to fall, but the yield curve at being sloped is positive and good for returns. And then you have the other side of the spectrum where you've got a number of alternative managers who are shorting the treasury market, maybe because they're using the short treasury to position for long equities in some form or fashion, right? So you have these really competing forces, and they're dramatic and they're significant, and it's a massive market, right? The U.S. Treasury market.
Yeah,
so there's lots of things that are happening maybe a lot of unintended consequences as well. And there's obviously pressure because of the uncertainty of what's going on with Trump's initiatives as it relates to tariffs. There is a fair debate, right, around tariffs, because the idea is that, well, if tariffs are left in place long term, they could be inflationary, right? That is a fair debate. The issue is, are these tariffs really going to be in place longer term, or are they simply being used as negotiating leverage, right? Because we can get into the nuance of what Trump's trying to do, which we haven't discussed with respect to the extension of the existing tax cuts. But he needs revenue. I heard Kevin Hassett specifically state this on CNBC, which was pretty remarkable.
Right.
He said the benefit of the tariffs is that they create revenue now before they actually begin the reconciliation process. And that revenue that's created right now ultimately feeds through to the CBO scoring that actually determines the amount of money that needs to be created in reconciliation to extend the tax cuts. So they're not considered as part of reconciliation, but they reduce the amount that you actually need to come up with during reconciliation. So there is a possibility, I don't know what the probability is, but there's a possibility that these are very temporary, that they're just needed to extend the existing tax cuts, and then they get pulled back over time. And so, and maybe not entirely, but as they already have been, significantly. And so the implication that they're going to be inflationary seems to be a foregone conclusion by a very large proportion of constituents in the investing community. And then there are others like ourselves where we say, well, maybe not so fast, right? We're not going to make that kind of a bet. That's a really big bet to make, because we remember that Trump used tariffs in his first term, and inflation was actually lower when he left office than when he took office.
Correct.
So it is not a given that
people argue that what he's doing today is different than what he did, back in his first term.
It absolutely is.
This is much greater.
The stance of it and the scale of it is absolutely very different.
Yeah, that's a fair part. But going back to rates, so what is your view with rates?
So our view is that rates right now are at very high levels, and that the Fed has not told us they're going to be raising interest rates, just the opposite. If you look at their statement of economic projections, they have 2 cuts priced in, and they have multiple cuts priced in for next year. Why would the Fed be cutting interest rates if the economy was strong? Why would the Fed be cutting interest rates if the economy was likely to ramp up at the current level of financial conditions? Because they're telling us that financial conditions are too tight. They know it. Powell said in February during his testimony to Congress that the current level of the Fed funds rate is still well above their neutral rate, or R star. Whether that's 2.5% or 2% or 3%, the reality is they're still at 4, right? 4 to 4.25. So they're still too high, and financial conditions are too tight. So the expectation is, if the Fed thinks that financial conditions are tight and they're going to need to cut rates more, then they're expecting growth to continue to slow, as we do. And that means that rates, not just for Fed funds, but the broader curve will likely come down. You'll still see further steepening, but we expect 10-year yields to come down as well as 30-year yields.
You do? Okay. So I wanted to ask you this. If and when the Fed cuts rates, right, that doesn't always mean that the 10-year and the 30-year will come down, correct?
Well, it doesn't always mean that the 10-year and the 30-year will come down as much. However, if you look at prior periods of Fed easing, it's very rare with the Fed cuts rates and the all rates don't come down to some degree, right? And so that's the difference. What you often see is a steepening of the curve, whereas rates come down more for shorter term bonds than they do for longer term bonds, but they still come down.
Do you have Andrew, do you have an idea? So if he were to cut 50 basis points tomorrow, what type of moves do you usually see in the 10 and the 30 year?
So maybe to answer your question another way is, if you look at every other prior easing cycle, you look at the average peak to trough on the 10-year Treasury yield in terms of from the high point to the low point in the actual easing cycle, it's about 250 to 300 basis points peak to trough. So we've declined by roughly 50 basis points from the peak. So going back over history, just looking at every other prior easing cycle, then that would indicate that rates have much further they could fall. But you could make a strong argument that this particular period is different than every other easing cycle. And the Fed doesn't want to go back to a 0% or close to 0%. And we believe they have no intention of doing that. So they will accept, in our view, slower growth and tighter financial conditions if they can be assured that they're not going back to 0% rates, because we don't think they want to go back to the zero bound ever.
Right.
Having said that, we were just at, call it 3.8%, 3.6% in September of last year.
Right.
So here we are at 4.5. Could we get back to where we were in September? Absolutely. Right? We don't have to move very much. All you need to see is a very weak payroll number, literally just one. And you're going to likely see rates drop dramatically, which is why we've been telling investors, not only do you have the opportunity to lock in very attractive yields today, certainly relative to preferred savings and short duration, in terms of that real return we were talking about, but you also have the opportunity to act before rates fall. Because we know in fixed income, you have to be early, you cannot be late. Because if you're early, you'll capture the move down in rates. If you're late, rates will have moved before you even get to express it in your portfolio.
It's one last question as it relates to this. I want to move on to one other quick one, and then we'll get Rob, and then we'll complete this. So, in a situation where the Fed cuts rates, but then you still see the 30-year move higher or the 10-year move higher, that's probably tied to deficits.
It's possible.
It
could be the market pricing in that the cutting of interest rates is sufficient to the degree to which it's likely to dramatically increase economic growth. And therefore, you as an investor in a 30-year bond need to be compensated with more income because growth is likely to be faster and thereby maybe inflation's higher as well. That's clearly not the environment that we're in right now.
Okay,
You're right. That could be, at some point, there could be an expression of, hey, look, I'm just worried that you're going to have to borrow too much, and therefore I just know that I don't want to own more of whatever it is that you're selling. We haven't seen that expressed as yet. It's just been talked about in headlines. Even if you look at the holdings of U.S. Treasury bonds between China and Japan in particular, the two other largest holders, each of them has around $1 trillion, just shy of $1 trillion in U.S. Treasuries. The Fed's sitting on $7 trillion in U.S. Treasury bonds, and they're effectively stopped winding down their balance sheet. And the Fed was just at $9 trillion before they turned QT on. So the Fed could absorb all the supply of the Chinese and the Japanese combined if they all woke up tomorrow morning and said, we don't want to own these. And the reality is, if the Fed's willing to let rates rise and the yield curve steepen, it's because they want it to happen, right? If the Fed doesn't like it, if they don't like seeing what's happening in the long-term Treasury market, they'll simply intercede and they'll come in and buy longer duration bonds. We know they've done it before, they'll do it again. So take confidence in knowing that anything that's happening in the Treasury market is because the Fed's allowing it.
Okay, Andrew, I want to conclude, if you could, within 2 minutes. I want people to understand when you invest in bonds, you can buy an individual bond for $1, and when it matures, whether you go out 5 years, 3 years, 10 years, you get your money back, and you earn that interest along the way. Most people are comfortable going with investing in a CD for 6 months or a year, and they're used to getting this principal back and getting a return. So you don't do that. You're an active manager, and I decided to hire you because I thought, on my view, was back then and is that you could add value above and beyond me just buying an individual bonds for my clients. So can you help my audience understand the value that an active muni bond manager brings to the table on how you do it?
Sure. So when it comes to munis in particular, it's important to understand the scope and scale of the muni market. There's $4 trillion in outstanding debt currently that one could, in theory, purchase. There's over 60,000 individual issuers in the municipal bond market, right? It's incredible, the scope and scale of it. And so as an individual investor, you can go out and buy individual bonds, like you said, yourself, or you can hire a manager to do it. The implication, by virtue as you're comparing the two, is that what you would buy and what we would buy are the same thing. And the reality is it's often not the case. Because as an active manager who does deep and ongoing credit research, we're constantly looking among the 60,000 different credits that in theory we could invest in to try to isolate bonds that we think are undervalued. And so just like a stock, in the sense that sometimes the actual upside return opportunity is not reflected in the current value, is true in bonds, specifically municipal bonds as well. A bond that's currently rated triple, let's say B, but actually in our view is a single A to double A rated security, it's just the market is not reflecting it yet, means that the yield on that bond is too high relative to the underlying risk. because the risk is actually lower than what's priced in. And so we would say, hey, let's go out and buy. Like we were just bidding on bonds this morning that we think are very attractively priced because it's effective monopoly. It's a utility, let's say a power company, that there is no other alternative, right? Where are constituents within a specific community going to go for their electric power? They can't go out and hire another utility to provide power to them or electricity. And whether the economy is expanding or contracting, we all turn on lights. We all flush toilets. We all need these essential services. So in our view, the benefit of an active manager is identifying those particular securities that are stable to improving credits that you yourself would likely not invest in on your own, buying structures that you might not invest in on your own, the types of coupons, and what's the value of the call features associated with those bonds? Where are they on the yield curve? Is the 5-year area of the curve attractive versus the 15-year area of the curve? A good example of that would be last year, and this is the dynamic nature of the muni market, which is why active management adds value. Last year, the 2 to 10-year area of the muni market was inverted. You got a lower yield on a 10-year muni than you got on a 2-year muni. That's very, very rare. We were suggesting to clients who were heavily exposed to the 5 to 10-year area of the muni curve last year that they should sell those securities. And we did for our clients. We are underweight 5 to 10-year bonds because we anticipated that the yield curve would normalize. It would mean revert. It would go back to the normal relationship of being more steeply sloped. And the way that would be expressed would be because the 2 to 5-year area of the curve yields would drop, and the 5 to 10-year municipal maturity, would not move at all. And that's exactly what happened. So if you look at the entire scope of the yield curve from 1 to 30 years, the worst performing area of the curve in 2024 was the 5 to 10-year area of the curve. So our ability to be underweight that area of the curve, where somebody, let's say, is laddering a portfolio, they're taking equal positions across the curve out to, let's say, a 10 or a 15-year maturity, they're effectively saying and stating and expressing in their portfolio that every spot in the curve is equally valued at the time they bought the securities. And the reality is it's simply not. And that dynamic has now changed. So now there are certain spots within 5 to 10 years that are now attractive versus where they were unattractive a year ago. So it's our job as a manager to go then proactively express that once again and make that change within a client portfolio.
Love it. Love it. That's great, Andrew. Listen, it's always great talking to you. I love having you on my podcast. Your perspectives are always very, very informative. So thanks so much for your time today. I really appreciate it.
Thank you. Really appreciate being with you. Thank you.